Zum Interview gekommen hier am Fondsprofessionell-Kongress ist Ariel Bezalel. Er ist Fondsmanager des Jupiter Dynamic Bond Fund. Ariel, good to have you here again.
Oh, it's an absolute pleasure.
Jupiter Dynamic Bond Fund is often described as an unconstrained bond fund. Everything and nothing. So tell us your story. What can the fund do? What do you avoid?
So unconstrained means many things. So when we say unconstrained, we mean the lovely thing about this strategy is that we can invest pretty much anywhere around the world. So, more opportunities for our clients. Then when we also talk about unconstrained, we also invest across the rating spectrum. So we're investing in high quality government bonds. So that involves taking macro bets and doing a lot of macro research to assess the interest rate outlook, and also thinking about how much interest rate sensitivity we want to have in the fund. But then on top of that, with the help of my extensive team of credit analysts at Jupiter, we're also able to move across the rating spectrum. So we look at investment grade companies, and we also lend money to high yield companies as well. And sometimes when we see some really compelling opportunities, we also do look at distressed, but in a very small way, but we do look there as well. So that really kind of gives you an idea of what unconstrained means. But the other thing I should highlight is, with the flexibility we have of the fund, we're also able to use certain tools to help mitigate risk. So when I talk about tools, I'm talking about using CDS or credit default swaps to mitigate credit risk. We also sometimes use government bonds. Whenever, seen over the last 10 years, whenever there's been a kind of risk-off phase in markets, government bonds such as US Treasuries work really well. And we tend to are active users of those kind of instruments. And then on top of that, sometimes we also use currencies as well. The US dollar actually being a prime beneficiary of any capital flows when there's a period of uncertainty. So quite a lot encompasses that unconstrained label.
The year 2018 has been a rather tough year regarding your performance. 2019, in contrast, it seems that you have been back on track, so to say. Would you agree?
So in 2018, for the first kind of 6 to 9 months of the year was really challenging for us, because we took the view that the Federal Reserve would fail to normalize policy and increase interest rates without causing damage. And so what we saw over the course of 2018, risk assets were rallying, government bond yields were moving up and up and up and up. And then once we reached Q4 of 2018, our conviction was growing that something was going to break. And all of a sudden, risk assets, once real yields in America hit 1%, all of a sudden risk assets were really struggling. And then we saw a plummet in the stock market, and that led to a big risk off. And then we saw government bond yields in America collapse as well. And that really played into our hands. So we saw the US 10-year get to as high as 3.25%. And literally over the subsequent months, we saw the US 10-year literally halve. And so in Q4 2018, we actually ended up outperforming the vast majority of our peers, and actually finished just outside our top quartile in the Morningstar Flexible Index, having been in the bottom quartile for much of that year. And yeah, as you highlight, we came back pretty strong again in 2019 with another year of solid performance.
For several quarters now, the strategic focus has been on safeguarding the capital of your investors by focusing on a balanced portfolio with government bonds, with high credit ratings, especially US and Australia, and selected corporate and emerging market bonds. Will that continue, that sort of strategy?
So investors need to really think about the economic cycle here. This is the longest economic cycle in post-war history. It's actually the weakest as well. Now, with that in mind, common sense kind of tells you shouldn't be really running as much risk as you were 4 or 5 years ago. So 4 or 5 years ago, we were running a lot of high-yield credit risk. We were running a lot of risk in emerging markets, in investment grade. But nowadays, we want to run a more kind of balanced portfolio, as you put it. Unfortunately, we think the world is more vulnerable to deflationary shocks rather than inflationary shocks. Now, what I mean by there is that when you have a world sitting on too much debt, so sitting on around about $250 trillion, approximately, and you have also aging demographics in much of the developed world, and even profound demographic changes in some of the emerging markets. And then we also see that the advent of the internet, the advent of companies like Amazon.com has simply made it very hard for companies to raise prices. So we think prices across, broadly speaking, across the economy are going to remain low, and that's going to keep interest rates very low for some time still to come. So with that in mind, and plus our concerns around the China outlook in particular, because be under no illusion, over the last decade, China is the marginal driver of global growth. China, in fact, has contributed more to global growth than America, Japan and Europe put together. So with China's economy slowing down over the last year to 2 years, combined with a European economy that's kind of struggling to get going, and combined with a US economy that feels very late cycle, we feel it's prudent to run what we call a barbell strategy. So that barbell strategy involves being pretty bullish in government bonds issued by the likes of America. And in addition to that, other AAA rated sovereigns we like are the likes of Australia, New Zealand, where yields are actually still positive, versus much of Europe where yields are negative in a lot of Europe. And then on the other side of the portfolio, we're selectively picking opportunities across emerging markets. So in emerging markets, you need to be very careful because a lot of countries are reliant on China growth, which, as I said earlier, is slowing down. So we like places like Russia, which from a credit perspective are very sound. And then if you want to be a bit more adventurous and a bit more opportunistic, you can find opportunities in some more exotic places, in kind of more shorter dated paper in places like Ecuador and Egypt. I think Ukraine is a nice long-term turnaround story as well, very selective there. And then within the high yield markets, it's a preference for certain special situations, and short dated paper is where we're getting a pretty decent carry over cash and companies where we believe our principal is sound, and we'll continue to get our interest payments. And this is off the back of the work that I do together with my, as I mentioned, my extensive team of credit research analysts.
To what extent do central banks and their decisions play a role for your investment strategy, for your decisions? Do they play a role at all?
Absolutely. I mean, central banks are front and center on everything. They've become, we used to call the big hedge funds, led by legends like Paul Tudor Jones, George Soros, the kind of masters of the universe. Today it's the central banks who are the masters of the universe. They're the people who move markets today. And over the last decade or so, we have seen continuous central bank intervention of some shape or form, whether it's interest rate cuts or through QE or even QT, quantitative tightening. And I'm afraid to say, I think central banks are going to be with us for many years to come. And so when you know that, and you know the boost that they can give to asset prices, as we've seen, in just the last couple of quarters in America, with the Fed's intervention in repo markets and the liquidity that's filtered into money markets appears to have made its way into the stock market. So yeah, they have a huge influence on asset prices. And so with that in mind, that is why, that's a big reason why we're still very active in corporate credit, such as emerging markets and high yield as well, because the liquidity they're providing is undoubtedly providing a boost to those markets as well, and we need to exploit that.
Thanks a lot for being with us, Ariel.
Absolute pleasure.
Thank you.